The Bank of England calls it forecasting. Psychologists call it anchoring. What those who were betting on a stronger pound today call it isn't something I can repeat on a family video. The pound tumbled against the dollar as the bank came out with predictions that rates could remain on hold for all of next year without creating much in the way of inflationary pressure. Even if interest rates were raised just twice in 2017, so reaching 1%, then the chance of inflation coming in above the bank's target would be just 56% in 3 years' time. Now, connoisseurs of central bank forecasts shouldn't be all that surprised. Central banks hate predicting that inflation is going to come in far from their goal, let alone far above target. The Bank of England's target, remember, is 2%. Those goals act as an anchor for their forecasts. You can see that on here. The red bars show the proportion of the bank's inflation forecasts for where price rises will be in 2 years' time in each of these ranges along the bottom. So the left of here means below target. This is just above the target, the 2 to 2.5, and the bank didn't once forecast that inflation would be above 2.5% in 2 years' time. This is in data going back to 2004 and comes from a report put out today by the bank's own independent assessment team. Now, it's half the time that inflation actually came in that range. So these blue bars add up to approximately half of the total, and that means that the bank, in effect, got its forecast wrong half of the time. Now, the bank's shorter-term forecasts were as good or better than those of private sector economists, but it's the 2-year prediction which really matters, because policymakers aim to set interest rates to achieve their 2% goal roughly within 2 years. Now here, on this horizon, the private sector came out better, although still, naturally enough, it was pretty dismal in its forecasting. Now, central bankers can quite reasonably say that the point forecast, the exact number, is rather misleading. It's the probabilities attached to the forecast which really matters. This is one of the reasons that most economic reports should be dismissed out of hand, because the degree of certainty is almost always missing. Now, the bank's different. It provides fan charts which show the probabilities it puts on each outcome. This, has to be said, is a great idea, but it's somewhat damaged by the finding in today's assessment that, and I quote, "the fan charts have not tended to provide an accurate guide to the eventual distribution of UK GDP growth and inflation outturns." In other words, they're hopeless. Now, the anchoring around the inflation target is absolutely the fault of the bank. But the failure of the forecasting is down to the inherent problem of trying to forecast something which is too complex to predict with even a pretense of accuracy. Governor Mark Carney gave a hint of this at his press conference today, admitting that no one has a useful way to forecast oil shocks. As you can see on here, inflation, which is the blue line, is closely linked in the short run to what happens to oil when oil reaches extremes. In other words, when there's an oil shock. Oil, I've got Brent crude here in red. Now, if you can't predict the oil price correctly, that means you can't predict inflation correctly either. And even hardened econometricians would accept that they can't predict the oil price. Now, there are 3 lessons in this for investors. First of all, watch out for bias in forecasts. It should come naturally, but people tend to take the central bank prediction as the basis for their own predictions. Secondly, watch out for economic forecasts in general, because they just aren't very good. And third, watch out for anchoring, the tendency to assume that the future will be like the recent past. It might be, but in everything from economic forecasts to corporate profit predictions to share price moves, we humans tend to put too much weight on the idea that they'll continue just as they have lately.